conference. Before we begin, I would like to inform you that there'll be a Q&A session at the end of this conference. Today we have with us on stage Tech Mahindra's CEO and Managing Director Mohit Joshi and Chief Financial Officer Rohit Anand. Without any delay, over to you, Mohit.
Thank you, Abhilasha, and good evening to everybody. You must excuse me because I have a bit of a bad throat, so please excuse the occasional coughing. And welcome. Welcome to our earnings for the third quarter of fiscal year 26. So we're starting the calendar year on a very positive note. The third quarter has delivered a very strong performance with most of our targeted market segments contributing very meaningfully to our results. Uh, Most importantly, the deal momentum has remained robust throughout the quarter. We've recorded our highest quarterly deal bookings in the last 5 years, our highest deal wins on an LTM basis in the last 5 years, and our largest deal win in Europe in the communications industry. This really underscores the strength of our client relationships, the relevance of our capabilities, and our ability to deliver long-term value at scale. Before moving to our third quarter business performance, I just want to touch very briefly on this large deal win in Europe. This is a strategic engagement with a leading European telecom provider. It's one of the largest wins in the company's history. And the multi-year partnership is about a comprehensive modernization of the client's applications across both the CTO and the CIO domains. This is aimed at accelerating innovation, strengthening digital resilience, and achieving AI-led operational efficiencies. This has been enabled by our deep domain expertise and proven transformational capabilities. This win further strengthens our leadership position within the telecom vertical. So now, having given you some details on our mega deal, I just want to turn to our performance for the quarter. So revenues have grown by 2.7% year on year and 1.5% quarter on quarter on a reported basis, and 1.3% year on year and 1.7% quarter on quarter on a constant currency basis, making this our fastest quarterly growth in the last 3 years. Moreover, this performance has been driven by broad-based growth across communications, manufacturing, high tech, retail, and healthcare. At the same time as we've grown revenues, operating margins have expanded by 290 basis points year on year to 13.1%. This really underscores the progress enabled by our improved operating discipline and the quality of our revenue growth as we have maintained pricing discipline and enhanced our revenue mix. For Tech Mahindra, the all-important communications vertical has grown by 4.7% year on year during the quarter. We are seeing signs of stability across the US, coupled with stabilization of top client spending. Europe is expected to move from a phase of stability into a growth phase supported by this large deal win that we reported earlier today. We believe the comms vertical is well positioned to be one of our growth verticals as we move into 2027. The BFSI portfolio has declined by 0.8% year on year, primarily due to higher than normal furloughs during the quarter and the passing of annual productivity gains for a large infrastructure contract in the rest of the world, which additionally impacted revenues, for the region. The long-term BFSI trends remain favorable, and we continue to make inroads in engaging clients with tailored solution offerings in this important vertical. And we continue to see good demand across digital transformation, customer experience, data and analytics, cybersecurity, and risk and compliance, coupled with AI adoption. Manufacturing continued its strong trajectory this quarter, building on the momentum from the previous quarter with a year-on-year growth of 11.7%. As stated earlier, we are seeing good traction in aerospace and in the industrial segments in the US, while in Europe, growth was supported by the ramp-up of a large automotive client during the quarter. The US automotive segment continues to remain in a wait-and-watch mode, and we expect demand trends to turn more positive over the medium term. The high-tech vertical declined by 4.6% year on year. However, it showed positive momentum during the quarter, driven by engineering services, particularly in the semiconductor segment. That said, we expect the high-tech sector to remain volatile as companies continue to operate under cost pressure and continue to exercise caution in their tech and ops spending. Retail, travel, and logistics continue to perform, delivering 11.7% year on year growth. This has been supported by a strong traction in our logistics business and above normal seasonality in the BPS business for retail. On a geography basis performance, the Americas has grown by 2.1% year on year. Europe delivered a strong growth performance of 11.2% year on year, supported by the large deal ramp up in European auto that I spoke about. Revenue from the rest of the world has dipped by 4%, primarily on account of furloughs and annual productivity gains. That said, our priority markets within the rest of the world, and we have called out these priority markets, they have grown by 12.9% year on year. And this reflects our continued focus on selected markets, which should better contribute to growth in the future as our mix continues to shift. If we look at our client portfolio, we added three $50 million plus clients year on year into our 50 million plus client bucket, reinforcing the strength and scalability of our client relationships. Additionally, revenues from our 20 million plus clients. Now, as you know, this has been a key focus area for us, right? Growth in our top accounts. This continues to be significantly higher than the company average. And I believe strongly that this performance underscores our focused approach to scaling strategic accounts and deepening long term partnerships by bringing tailored solutions to clients and applying the distinctive domain expertise of our experienced staff. From an AI perspective, AI continues to be a growth pillar of our strategy as we support clients in moving from experimentation to execution at scale. We are seeing AI increasingly embedded across large enterprise engagements, driving business experience, process and operations transformation, IT build and change, as well as IT operations. Client programs are shifting from pilots to scaled multi-year initiatives that are integrated into their operating models. In line with this, our partnership with Google positions us as well to accelerate the adoption of Gemini Enterprise, leveraging the Gemini 2.5 multimodal models to drive human-centered innovation and scale AI adoption across global enterprises. We have also signed a memorandum of understanding with the UT Tech Dallas for AI-led innovation, skill development, and research. We will also launch our first Makers Lab in the US, in Dallas, focusing on pushing the boundaries of AI, data science, Gen AI, agentic AI, quantum computing, cybersecurity, and cognitive network innovation. In terms of deal wins, as shared earlier, our deals wins this quarter stands at a whopping 1.1 billion, including the mega deal stated earlier, representing a 48% year-on-year growth on an LTM basis. This strong performance is a testament to the focused investments that we have made in strengthening our sales engine, our solution-based go-to-market offerings, and the growing relevance of our AI-enabled capabilities, which are resonating well with clients and contributing meaningfully to these wins. Other notable deal wins include being selected by a global HCM SaaS company to provide implementation and customer support across its products portfolio. This engagement with a California-based company leverages Tech Mahindra's HCM and CX centers of excellence, along with capabilities in AI, automation, solution configuration, and data integration to drive greater efficiency, scalability, and innovation, resulting in enhanced customer experience and optimized cost. Tech Mahindra was selected by a leading European aerospace manufacturer as a strategic partner to support engineering across all aircraft programs. This service includes an end-to-end capability for aircraft operators and MROs, leveraging Tech Mahindra's deep expertise in aeronautics and strong delivery capabilities. This collaboration will ensure comprehensive support engineering across all aircraft programs. We were selected by a leading US-based comms provider to lead their transformation and system integration initiatives. This strategic engagement focuses on consolidating operations into a single trusted partner, modernizing legacy systems, and reducing technical debt through automation and best practices, leveraging our proven delivery excellence and deep expertise. This will drive cost optimization, accelerated growth, and enable scalable talent deployment through a core flex model. From a healthcare perspective, we were selected in the US as a strategic partner by a healthcare provider to lead their enterprise digital transformation. This engagement includes optimization, simplification, and cloud migration, transformation to a unified tech stack to deliver better experience, cost savings, and moving them into a managed services environment. From a banking perspective, we were selected by a leading US-based banking institution as their strategic partner to modernize their enterprise payment platform. This incorporates real-time rail capabilities across markets, cash management, and wealth management, leveraging our center of excellence to deliver large-scale, complex transformation and using our deep domain mission-critical banking platform capability. From an awards perspective, as I'd mentioned during my last earnings, we marked our 39th anniversary on the 24th of October, 2025 with our brand refresh. Since then, the refreshed brand has been really well received across stakeholders and has reinforced our positioning around innovation and AI-led capabilities. Further reinforcing the strength of our brand, we received the Best Brand 2025 award at the ET Now Best Brands Conclave by the ET Edge. I'm proud that our refreshed brand encapsulates who Tech Mahindra is in the AI era, agile in execution, bold in vision, collaborative in our culture and with clients, and discerning in our decisions. This branding evolution positions us as the future-ready transformation partner enterprises trust to drive digital reinvention with intelligence and speed. At its core, our refreshed brand reinforces our promise to help clients scale at speed through AI-led innovation and precision. Last quarter, we successfully concluded the third season of the Global Chess League right here in Mumbai, reinforcing our commitment to innovation, strategic thinking, and global engagement. Over time, these efforts support brand equity, talent attraction, and a differentiated market presence. This creates sustainable value for our shareholders. Tech Mahindra has once again been recognized as a global sustainability leader in the S&P's DJSI. We have proudly regained our number one position globally in the. We have also been A list for both the Carbon Disclosure Project Climate Change and the Carbon Disclosure Project Water Stewardship 2025 program, a testament to our collective commitment to sustainability, transparency, and environmental stewardship. So finally, as we close, I would like to highlight the launch of our new culture model. It's called Limitless Together, which brings our employee value proposition to life. Limitless Together reflects our belief that when we unite with purpose, support each other, and push boundaries, there is no limit to what we can achieve. It is more than a phrase. It defines how we work, grow, and succeed as a team. As Margaret Mead once said, never doubt that a small group of thoughtful, committed citizens can change the world. Indeed, it is the only thing that ever has. And so I have no doubt that a group of thoughtful, committed tech mighties again will change the world. I believe this alignment, Limitless Together, is translating into stronger execution and that each quarter's performance takes us that much closer to our FY27 goals. To reiterate, we expect to grow higher than the peer average by the end of FY27 while progressing towards a 15% EBIT margin. This strong quarter reinforces our confidence that we're on the right path and building sustained momentum towards our long-term aspirations. With that, I hand you over to Rohit, our CFO, to take you through the details of our financial performance.
Thank you, Mohit. Very warm welcome to everyone joining us today from across geographies, online as well as in the room. Turning to our performance for the third quarter for fiscal year 26, this was a very well-rounded quarter, with majority of our growth engines coming together to deliver a very strong set of results. Our revenue for the quarter stood at $1610 million US dollar, representing 1.5% sequential growth and a 2.7% year-on-year growth on a reported basis. On a constant currency basis, adjusted for FX, revenue increased by 1.7% QOQ and 1.3% YOY. In rupee terms, our revenue was 14,393 crores compared to 13,995 crores in the previous quarter, instead of increase of a 2.8% in sequential basis and 8.3% on a YOY basis. For the quarter, our operating profit was 211 million, with operating margin expanding close to 100 basis point to 13.1%, marking the ninth consecutive quarter of margin expansion. Gross margin expanded by 120 basis point QOQ, driven by improved productivity and volume growth. In INR terms, operating profit reached 1,892 crores, representing a robust year-on-year growth of 40.1%. These results reflect disciplined execution, sustained focus on efficiency across the business while maintaining momentum in top-line growth. Other income for the quarter was at a loss of 2.4 million US dollar, primarily on the account of forex losses. As of December 31st, our hedge book stand close to 1.05 billion compared to 1.33 billion in the previous quarter. Our effective tax rate for the quarter was 25.7%. The normalized ETR for the full year stays close to 27%. Our profit after tax before exceptional items for the quarter was 9.2%, up 180 basis point on a YOY basis. The exceptional item for the quarter relates to the one-time provision of USD $30 million in accordance with the new wage code notification. Through disciplined capital allocation and sharper execution, we've strengthened our return on capital employed to 26.9%, reflecting the business that is not just growing, but growing efficiently. Our year-till-date free cash flow to operational PAT ratio is 123%, which gives a validation of a working capital unlock that we're delivering in the business. During the quarter, the free cash flow was 194 million, driven by strong collection efficiency and continued improvement in working capital management. Our DSO decreased by 4 days on a quarter-on-quarter basis, driven by reduction predominantly on our unbilled receivables. Our total deal wins in the quarter stood at 1096 million, reflecting a growth of 48% on a last 12-month basis. The quarterly deal win this quarter is the highest we've had in the last 5 years. As we move ahead, we remain focused on sustaining our operating rigor, strengthening execution, and delivering our F27 strategic goals, where we continue to remain on track. Thank you.
Thank you, Mohit and Rohit. We will now conclude this stream. For those of you who have joined us on social media, thank you again for joining us. We will now open the conference for a short Q&A session for media friends who've joined us here and virtually. For those who are online, kindly post your questions in the chat box. We can start with questions. If you can just give us your name, publication, and then your questions.
Hi, I'm Rachna from CNBC TV 18. I wanted to understand, your peers have flagged a return of discretionary spending. Are you seeing this translate into actual deal closures yet, or which verticals are leading this portfolio?
Well, if you see our earnings, right, we've had, like I said, our best quarterly performance in 3 years, largest ever deal wins in the past 5 years, a 48% improvement in large deals over a last 12-month basis. So I think all of this reflects the fact that the demand environment has certainly strengthened a bit. I wouldn't say that there's a dramatic change or that, we're off to the races, but it certainly reflects that the environment is slightly more stable, but that within that, we're delivering much better. You would have seen that I think our numbers are slightly ahead of our peer pack as well.
Right. Beyond utilization and cost controls, what are the next incremental levers you're seeing for margin expansion?
So look, I think, we spelled out when we'd launched this program about 2 years ago, we'd spelled out a full medley of measures that we were going to be taking. Some of these were linked to the markets in which we operate. Some of this was linked to our focus on our top accounts, where obviously we're able to sell multiple services and have better margins. Some of it was related to sort of the operating discipline that we're enforcing. Some of it is linked to the higher pricing that we're able to enjoy because we're selling more higher end services. So I feel it's a combination of these things, which is why you haven't seen like a single quarter of massive margin jumps and then a decline. You've seen, as Rohit mentioned, 9 quarters of consistent margin expansion. So it is not one thing, it is a multiplicity of factors that we hope still have some way to run.
I'll take the next question from virtual media. This is from Ashish Agashe from PTI. What led to the expansion in margins on a Y-on-Y basis? What were the headwinds on it, and what is the outlook on it going ahead?
Yeah, so I think, as Mohit mentioned, both on a YOY basis and QOQ basis, we've expanded margins significantly. As we'd mentioned, we had a 3-year plan on getting towards a 15% EBIT in F27, and we've said we'd articulated in our plan as well as an yearly update and a constant quarterly reiteration of that That will continue to work on various levers from pricing, delivery-led growth to cost efficiency measures on automation, and multitude of portfolio companies that we wanted to integrate. So it's a multitude of measure under Project Fortius, led by our CEO, and jointly supported by the entire organization. So we continue to make inroads of that. So it's a multitude of measures that driven the margin expansion. And as we move forward, we're quite confident that we'll continue to expand on that journey while delivering high quality revenue.
Yeah, Debangana from Money Control. Firstly, I wanted to understand your IT headcount has been plunging over the past few quarters. So, is this a shift in the hiring strategy, or is this an impact of AI that we are seeing? My second question is: your peers have been talking about increasing fresher salaries for particular segment of hiring for specialized skills, and that has gone up to as high as 20 lakhs or 22 lakhs per annum. So is that something Tech Mahindra is looking at as well? And my third question is for Rohit. Wanted to understand the margin impact going forward, given the new labor code that has come into place.
Yes, thank you. Well, I'm just amazed that you're calling a 2% or 3% change in a year plunging. I shudder to think what you'd have said if you were at 5 or 6%. I don't think 2 or 3% is a plunge in IT headcount by any stretch of imagination. Look, the reality is, as we shared previously, as we become a lot more efficient in our fixed price programs, right? And I think we were quite clear that we see our fixed price programs as one huge area where we can drive a lot of efficiency. As we become more efficient, that has freed up capacity for us, right? That has freed up capacity. So rather than going ahead and hiring or replacing attrition, we have used that as a lever to drive our growth, and that's seen in our revenue growth as well, right? Our revenue growth, our revenue per employee has continued to increase, while our headcount has more or less stayed stable over the past couple of years at about 150,000 people, pretty much since I joined. I feel that there is clearly an impact of AI in terms of the fact that people are expecting higher levels of productivity, whether it's from a development perspective or from a support perspective. But I do see the business opportunity still remains very robust for us and for the industry. As far as the question about sort of freshers is concerned, we did have a lower level of fresh hires this year as compared to the previous year, but that's because of the demand environment. We flagged it out initially itself. Last financial year, we had taken on 6,000 freshers. This year was lower than that. And like our peers, we continue to hire some developers, maybe with a 1 to 2 years experience at a significant premium. If we can see that they're bringing in sort of a top coder or the very deep bench of technical skills, we do pay for that as distinct from our standard engineering entry level adoption program. So there is a level of differentiation there. But usually these are people with some experience rather than fresh from university.
Yeah. And on the ongoing impact, we've taken the one-time impact of the new wage code. There'll be ongoing impact as well, as you rightly mentioned, will be anywhere in the range of 10 to 20 basis point. We'll see as we move forward, and we will, as we've worked on a margin plan, make sure that we incorporate that to offset and still reach out. That's the intention.
Hi, gentlemen. Sorry, I'll just take a question online. This one is from Sai from Reuters. How is the deal pipeline? Can we expect similar deal win numbers in the coming quarters? Also, how is FY27 looking like? Will it be better than FY26?
Well, look, I think the deal pipeline is still very robust. Now, the thing with large deals is that they're lumpy, right? They're lumpy, and sometimes you close a deal in a particular quarter, like this time around, and we jump from about 800 to 1.1 billion, and sometimes deals can get deferred. But overall, I can say that the strength of the pipeline is very strong, and the pipeline is strong across geographies and across verticals. As far as FY27 is concerned, it's a bit early to tell. We saw last year that there was a little bit of a turbulence in February that impacted the start of the year for pretty much everybody. But on the whole, I think we've been quite consistent about the fact that we expect to outperform our peer average in FY27, and that conviction and that confidence still very much stands.
Please go ahead.
Yeah, hi. Just want to understand, Mohit, most of your peers have started not breaking down, but at least giving us some sense on the AI deals. If you could also, by when do we see Tech Mahindra doing that? Either the size of the deals or what is the proportion of the TCVs that you're winning from them? Rohit, could you just elaborate on this acquisition that is New Democratic Front? I mean, if you could just tell us more about what is that? Thanks.
Sure. So look, I think as far as the AI piece is concerned, candidly, I'll say almost all of our large deals, right, are now AI infused because it's almost impossible. No, it is not almost impossible. It is impossible to win a large deal, whether that's a development or a transformation or a BPS or a support deal, unless you're able to show your toolkit, like in our instance, TechM Orion or Swifter.io, to show that you will be able to drive productivity through this. Now, the challenge that we face is that either your definition of AI is very narrow, which is you're selling a large language model or a small language model or doing AI specific consulting, or it's too broad, right? Saying we're using our tooling that enables us to use AI. What I will say is that almost all of our clients, right, and almost all of our clients over $20 million, there are AI programs in position there, and we are working with clients to move these from mere pilots to more wide scale adoption. And we will try and think of an appropriate metric to report. So the problem is that either the metric is, like some of our peers are reporting that 95% of our clients are using AI. I mean, that is true. Or the metric is too narrow, right? Saying we're doing, a couple of $1 million in model sales, for instance. The other thing that we're doing, which is very interesting, on which we had actually written a white paper with Forrester, which was released just about 3 or 4 days ago, is a new pricing model that incorporates AI. So essentially, you have a pricing model where you're partly charging for human labor, and that is very clearly called out, and partly where you're charging for digital labor, right? The problem is that how do you specify digital labor? And what we've said is that the lowest common denominator for digital labor is token consumption. So we will try and define how many tokens are consumed and have pricing linked to that. So we are giving a lot of thought to how we can, more than reporting, how we can change our pricing model for clients to clearly charge for digital labor distinct from human labor. But I feel that adoption will obviously take time.
The entity, it's not really an acquisition, it's a group company where we've invested 37 lakh Indian rupees with some restructuring within the firm based on, it's a Section 8 company, so not really an acquisition.
Yeah.
The next question is from Mohit Pandey from Analytics India magazine. How is India AI Mission's upcoming LLM going to affect the company's AI revenue going forward?
Well, I think it's not going to have a revenue, a significant or a meaningful revenue impact at all. But I feel it is an important part of the capability creation and demonstration within TechM, which is that we're the only large SI that has been picked for this national AI mission, and really reflects the strength that we have as a company in having developed a large language model from scratch for Hindi and then for Bahasa Indonesian. Our Chief Innovation Officer got an opportunity just last week to present it to Prime Minister Modi. And this model that we're building as part of the National AI Mission will really enable large-scale science-based education for students from year 6 to year 12. And so it's an important part of capability creation, an important part of building out the sort of the educational infrastructure for the nation.
Perfect. Anyone?
Hi, sir. I'm Himanshi from Economic Times. My first question is about the new labor codes. There is an assessment in the industry which suggests that for a lot of employees, take-home salaries are expected to go down because of higher PF takeouts and gratuities. Have you seen that in your internal assessment for Tech Mahindra? If yes, will that weigh down on upcoming increments? Because do you want to offset that loss, or do you want to give higher increments because of that? My second question is that M&A activity has really heated up in the industry, where your peers have announced strategic focus on now capability buys, and some of them is on new technologies. Are you also looking in that direction?
Sure. So first on the labor code, we're still studying the implications of the labor code. While obviously, from what we can see, we have made certain provisions for, so the historic costs that we'll have incurred. And as Rohit mentioned, we do see some minimal ongoing costs in the future as well. We are getting detailed HR and legal opinion about how salaries should be structured in the future, obviously to benefit the employees. But that has not been finalized yet. We continue to work on that. As far as your sort of your second question was on
M&A.
on M&A. Yeah. So on M&A, look, I feel that we have articulated a strategy that our growth will largely be organic in terms of, till we hit FY27. We continue to look at a number of, tuck-in acquisitions that bring us specific capabilities, but we have not narrowed down on any one so far. We are very keen to make sure that we're able to consistently deliver organic growth and the profitability increases. And we are not, looking at any large-scale transformational M&A at this time, even though we'll continue looking at tuck-in acquisitions.
Thank you.
I'll just take another online. The next one is from Just Bhartia. How would AI agents impact billing and delivery for the company? And how are you billing clients when it comes to AI offerings?
Yeah. So I think, look, as far as AI offerings is concerned, let's say, at one end, if we're building a large language model or a domain small language model for the client, we can charge them for that, right? If there is a specific implementation we're doing, for instance, of Salesforce Agent Force, we're charging them for that. But then when it comes to doing a large complex program, the AI that we use really goes as a productivity benefit for the client, which is why we think it's very important for the industry to develop a standard for how we will actually charge for digital labor. Because just now, the digital labor really comes in as a productivity benefit for the client. And the industry is really giving just one price to the client. So let's say we were doing something for $100. We're now saying we'll do it for $80 and 20% is productivity. We really want to change this paradigm and charge the client separately for human labor and for digital labor, because it is hard to price for digital labor, because what is one agent for you could be 10 agents for me. We want to be able to charge it based on token consumption. And we have written a very detailed paper, and we would really encourage you to read it, with Forrester on how this new pricing model will work of charging separately for digital and human labor, and the use of vector scores to be able to deliver large and comprehensive AI transformation for our clients. So we've given it a lot of thought, and a detailed paper is already out, and we're using that paper as the base to now price for our large programs.
Yeah, hi, Valerie from Hindu Business Line. Just on the headcount bit that you had spoken before, regarding freshers, is part of the change in their response to do with the H1B changes, developments that are happening right now? Historically, this sector has been a sort of a way for Indian employees to get into the American dream. So with the H1B developments, are you seeing any kind of change in terms of the fresher enthusiasm towards this sector? That is one question. Second, I might have missed this, but could you share any color in terms of the high-tech vertical and how it has developed? What kind of a response you're seeing from clients right now in terms of discretionary spends and otherwise? And also, in terms of Gen AI, could you also talk a bit possibly about the possible disruption in the BPO business because of this?
Sure. So I think three questions, right? The first question is on freshers.
Yes.
So I don't think the fresher sort of adoption is linked at all to H1s, because it is not like you can take a fresh graduate student and move them on an H1. Our H1 pool, like we shared previously, is very limited, and the bulk of our workforce in the US is US citizens or permanent residents. So I don't think the two things are linked at all. I do feel that technology and IT services and BPS remains a very attractive option for for students and for graduates in the country, and we are seeing a lot of demand, right? We are seeing a lot of people wanting to join the industry, so I don't feel that the attractiveness of the industry has diminished per se. As far as the Gen AI and its impact on the BPS business is concerned, candidly, we see a consolidation happening. As you see, our BPS business has continued to deliver sort of market-beating growth year after year, quarter after quarter. So we are seeing the benefits of consolidation, because being a provider that plays both on the tech and the AI side, as well as on the BPS side, we are therefore replacing maybe the pure play BPO players and getting the benefit of that consolidation. So I do feel that this AI wave has been a positive for our business. And as far as the high-tech sector is concerned, the high-tech sector has done very well on a quarter-on-quarter basis, right? So on a quarter-on-quarter basis, it's been a high performer for us. But on a year-on-year basis, it's been challenged. Partly is because, as we shared in previous quarters, we had seen a drop, because of one of our large semiconductor clients ramping down. Even though that has now on a quarter-on-quarter basis started improving, the YOY picture was still negative. I do feel that in the high-tech sector, we still continue to see a reasonable amount of volatility. So I feel that that sector will remain volatile for the next couple of quarters, even though our position remains, quite strong then.
Any other questions here?
Just to follow up on the H1B, Mohit, we did hear a lot of people, coming here for the visa stamping, and then suddenly the dates have changed. Has Tech Mahindra also seen some of its employees go through this? And what kind of options are being provided by the company? Can they work in India, or they have to wait? Yeah.
There's nothing meaningful that we've seen, and like I shared, right, our H1 numbers are very small, right? Our H1 numbers are very small from an overall perspective, so it's not really something that is impacting us. Maybe there are always a handful of people where you have delays, but it's nothing meaningful from our perspective.
So just lastly about the new pricing efforts that you're making on the productivity part and really passing on the token cost to the client. But, building these digital agents, deploying them, monitoring workflows, that also require a significant effort and monitoring and, really innovation in training those agents. Passing on just token cost, do you feel that it could add up to your margins?
That's a very good question. Look, I think the thing is that we have to continue investing in R&D anyway, right? The work that we'd initially done to build the Indus project was an investment from our perspective. And we have to build this tooling to win clients and projects. When we're talking about token consumption, some of those tokens will be consumed by models that we have built, right? So we will get the benefit of that. Some of them could be tokens consumed that, that are built on models the client has created or third-party models. And we will be charging a markup where appropriate on third-party models, right? So it's not going to be that we're just going to be a pass-through for token pricing. We will be using that as well as a revenue and a profit source for us. It is just going to be completely transparent to the client, right? What is it that you're paying for digital labor? What is it you're paying for human labor? And if you're paying X dollars for digital labor, what is that based on? It will become very clear. And if there's a huge drop in token pricing, for instance, the client will get the benefit of that transparently. See, one of the reasons why clients are afraid to sign long-term projects just now is because they're saying, look, if I sign on to a multi-year project and the price for AI drops suddenly, what do I get, right? So this is a way of making it transparent.
Sure. Thank you, everyone. Sorry, we'll have to conclude now. We'll now be concluding the conference. Request you to please reach out to us in case you have any additional queries. The recording of this conference will also be available on our website and social media channels. Thank you once again.
From overnight global cues to live Dalal Street moves, we decode what matters for your money today. From stocks to sectors to the top business news. We've got your morning game plan covered. Watch me, Abha Bakaya, as I bring you the opening bell action Monday to Fridays, 9:05 a.m. only